Hello, everybody. Thanks for joining us. We've got a wonderful topic today. The number one objective of every retirement portfolio. I thought this was going to be a fitting topic for the first of our educational series on YouTube. We will be posting a new tidbit of education every single week, along with a bunch of other content. So thank you for joining us. Let's jump right in. The biggest problem with withdrawing from portfolios is math. It's actually pretty simple math too. And so we need to understand the difference as we go through our phases of life. And those of you that have seen a lot of our full educational classes have seen this slide before. This math is so important to understand because it explains the difference from the years that you're trying to build your wealth to the years that you're trying to distribute your wealth. So let's look at this math. Let's start with that $100,000 portfolio. Okay, so we have $100,000, we're going to invest it. We find a great little investment, we throw the money in, and then poof, the world falls apart and you lose 50% of your money. Okay, so you had a portfolio, $100,000, that's how much you put into this portfolio. You lost 50%, now you only have $50,000. So the question that we have for math geeks out there, this is an easy piece of math, but for weird reason, a lot of us, our brains just hurt when we look at this. So the question is, how much do you have if you earn the same 50% back next year? Meaning your portfolio went down 50% and up 50%. How much money is left in your portfolio? We started with 100,000, it went down 50% and back up 50%. Well, for those of us that took our time and did that math, we only have 75,000 left. Okay, that's the unfair part of investing, is when you lose, you have to gain more just to get back to square one. Okay, so when we lose 50%, we lose 50% of 100,000. That means we lost $50,000. But now when we gain 50%, we're gaining 50% on 50,000, which is only $25,000. And that's why we're back to 75, not all the way back to $100,000. So please, please, please understand that the math works against us when we're investing. So we have things to fix that. So let's start with a baseline here. What if we took no money from this portfolio? We put no money in. We're in those preservation years. Okay. So we put 100,000 in. We're just letting it ride. It'll come back. Don't worry. But how much does it have to come back? What percentage does your portfolio have to earn to go from 50,000 back to 100,000 so we can say we broke even? And that math is 100%. Our portfolio has to earn 100% after losing 50%. Okay? Again, doesn't sound fair. Doesn't sound fair. So when we're in our wealth building years, they tell us things like dollar cost averaging. They tell us things like buy the dip, like all the stocks are on sale, go buy more. Those are all things to give us confidence to keep investing through the turbulence in the stock market, okay? And for a lot of us, we've seen a lot of big downturns in our lives, and we've seen them come back. Now, most people will tell you, well, it doesn't have to come back, but it has been. Our stock market has been very resilient. When it goes down, it tends to come back and come back higher, okay? So that works out for us. But if you're in your wealth building years, we keep getting told we got to keep investing through this turbulence. And there's actually a mathematical reason why. So let's look at this same scenario. We're going to do apples to apples. We're going to put 10,000 into this account. Okay. So we're in our wealth building years. The market just crashed 50%. We started with 100. We've invested $100,000. It's now down to $50,000 in that portfolio. Okay, we put 10,000 in. So now we have 60,000, but we've invested $110,000. So we have to earn enough to break even, which means we have to go from 60,000 to 110. Okay, so how much do we have to earn to go from 60,000 to 110? Most of us can't do that math in our head, but it's 83%. Okay, now the only thing that you need to take away from this is, did putting money in help us recover or hurt us? And the answer should very clearly be it helped us. We only have to earn 83% to break even, okay, as opposed to 100%. By putting no money in, taking no money out, we had to earn 100 just to break even, whereas putting money in, we reduced how much. But the cool thing, and this is why this really helps you build wealth, the cool thing is you have more shares, and each of those individual shares, whether it's mutual funds or stocks, they're all individual shares and they're all independently growing. And now you have more of them. Okay, so once you break even, once you get that 83% growth, you have more shares all independently growing, and that's how you build wealth. Okay, that's the important part to understand. That's why this worked so well in building your wealth. If you were brave and you made it through all the big turbulence that we've had and you kept putting money in, you were able to build a tremendous amount of wealth. And that's why a lot of the baby boomers has huge IRAs. We've seen lots of wealth built up in those baby boomers because they put a lot of their money in the stock market and they were brave. Okay, that's the interesting thing. But the hardest part is this transition to retirement. We built our wealth this way, so it's got to be the best way to invest. Well, that's wrong. That's the scariest part about investing in retirement. For those of you that actually need your money in retirement, for those of you that realized you saved all this money so you could spend it in retirement, you don't want a downturn in the market to stop you from enjoying your retirement. Okay, so all of a sudden, let's change the scenario. We retired. We no longer are putting money into our portfolio. We're taking money out. Okay, so what happens if we take 10,000 out in this scenario? So we invested 100,000. We lost 50%. We only have 50,000. We needed money. We took 10,000 out. Okay, so now we only have $40,000 and our total invested is 90,000 because we took 10 of it. Okay, so now we have to go from 40,000 to 90,000 just to break even. Not make back the 10,000 we're spending, just to break even with the money that we put in. Okay, 40,000 to 90,000. We now have to earn 125%. We just dug ourselves into a pretty deep hole. And when we're retired, the question now is, are we going to recover before we make another withdrawal? That is so scary in retirement. This is how you destroy your wealth. Because I want you to notice one very important thing. By putting 10,000 in, we saved ourselves 17% growth. Our portfolio does not have to grow that additional 17% just to break even. Okay, that helped us. But now we took 10,000 out and we hurt ourselves 25%. We have an additional 25% that we have to grow before we break even. Okay, this is the scary part about investing in retirement. This is why your portfolio changes as you head into retirement. Okay, most of the traditional shops, all those target date funds, all they're doing is moving more and more of your portfolio towards bonds because they want more stable investments. Now, most of you are realizing bonds are not a great investment, especially for retirees. Okay, they used to be great. Bonds used to be great. They're not anymore. Please be careful with them. When interest rates go to zero, the value of those bonds are as high as they can be. The only direction bond values can go after hitting zero is bond values are going to come back down, which means you're going to lose money. Okay. And when we raise interest rates, we're combating inflation. You're losing money in your safe part of your portfolio. Please don't do that. I've been screaming that for so many years. Okay. So the other problem with this idea of withdrawing money is really this overall effect on the portfolio. I used a big example of a 50,000 or 50% loss. Okay. So sometimes the market goes down 50% and comes right back. Remember the pandemic? That moved fast. Okay. So when the market goes down, we're like, no big deal. It'll come back. That scares me. That really does. How quickly we forgot 9/11. We went down 3 years straight. If you're retired, does that mean you're not going to touch your portfolio for 3 years because you don't want to pull from losses? We can't live our lives like that. So we have to understand that when we go to retire, the order of returns can matter. Okay. So here's non-retirement. We take $100,000 and we're going to deposit it in one of 3 portfolios. We're going to choose which one wins. Okay. This one's called volatility later. All this is the S&P 500 from 1990 to 2010. So we have a straight up decade and then the lost decade. Okay. From 2000 to 2010, a lot of people refer to that as the lost decade. Most people that were investing in that decade, it was pretty not good. Okay. So this is one choice. Do we want to put our 100,000 in this choice? Here's the next choice, volatility early. So exact same investment. This is the S&P 500 from 2010 back to 1990. All I did was flip-flop it. You got the -4 up here, the -4 down here. You got the 12. All I did was flip-flop it. There's 2008, there's 9/11, there's 2008, there's 9/11. It's exact same returns, just in the opposite order. And then all I did was take the mathematical average, which was 6 1/4. So here's a CD making 6 1/4 every year. My question to you is, which one do you want to put your 100,000 in? And your thought in your head is, I want the best performance. I want to make the most amount of money. Okay. Not what makes us feel good at night, because we'd all just choose 6 1/4 every year. Nobody likes going through this turbulence. We want to know which one makes us the most money. Okay. So again, we're not putting money in. We're not taking money out. It's a one-time deposit. We're going to earn. We want to know which one makes the most. And the answer is all 3 are exactly the same. The order of returns doesn't matter. Okay. So here, think about it like this. You own a mutual fund. That mutual fund says, hey, the 10-year average is 10%. Okay. Well, that's a mathematical average of the returns for the last 10 years. It represents the end point in a specific period of time and what these investments average. Well, these are the same returns. We have the same time period, 20 years here. So the mathematical average is going to be right in between the two. They're going to take different paths, but they are the same investment. Here's the problem. When you go to retire, that principle that we just went through changes. So here's what happens. We take that 100,000, we put it in each of these, and we take 6,000 out a year, and look how they change. That investment actually looked pretty good. Think about this. You put 100,000 in an investment, you take 6%, $6,000 out every single year. And after the lost decade, after 2008, we still have more than we started with. I'd be pretty happy with that investment. Okay. Holy cow, what happened to this one? And by the way, the mathematical average means nothing now. It is not the mathematical average. It does not represent either of these at all. And all we did was start taking money out of our portfolio. So it's easy to explain what happened to the green line here. Okay, think about this. We put 100,000 in, we're taking a 6% withdrawal rate. That's $6,000 out. Okay, so we're pulling $6,000 out of $100,000, and boom, we hit a big downturn. And instead of having 100,000 that we're pulling 6% out of, we have 60,000 and we're pulling 10% out. Well, 10% is hard to keep up with in any portfolio. And so boom, it hits 9/11 and the portfolio is destroyed at that point. You cannot keep pulling $6,000 out of this portfolio. Okay. You're talking 20-30% withdrawal rate. No portfolio will ever keep up with that kind of a withdrawal rate. So you can see the order of returns all of a sudden made a big difference. You hit a turbulence early in retirement and you will blow out your portfolio if you keep withdrawing. Okay. Whereas we hit a skyrocket in the stock market when you retire, And now you're pulling $6,000 out of 250. Well, that's, Warren Buffett style, pulling pennies out of billions. You're fine. You can live forever on that. We go through crazy turbulence like the lost decade, and you're still fine. You have 140,000 in there. Okay. But the other thing you have to know is my portfolio averages, my mutual fund says it's a 10-year average of X amount, means absolutely nothing, because you're going to change that math when you start taking money out. You could look at a mutual fund that averages 20% and a mutual fund that averages 5%, and the 5% is going to beat the 20%, and it'll make no sense to you. And it's because the mathematical average is 100% meaningless the day you start taking money from your portfolio. It's all about the turbulence, when it hits, how it hits, and the average does not have anything to do with that. Okay? So you have to know that just because somebody made 80% on their portfolio, that doesn't mean it has anything to do with you. It has zero relevance. If you need your money, turbulence will destroy your portfolio if you continue pulling out of there. You have to have ways to earn that don't come with losses. So let's drive this home with one last scenario here. You have a choice. You have $100,000. Do you want to throw it in the stock market, or do you want to throw it in a CD? Okay. And I think most of us know in our wealth building years, the stock market did a lot better. Okay, here's 2010 to 95. We have half of it going straight up and the other half of it going turbulent. Okay, well, 7% is better than 3%. There's no tricks here. Okay, I'd rather earn 7%, and I don't care how I get it. I'd rather earn 7%. It doesn't matter how turbulent it is. 7% is better than 3% every day of the week. But is it? I'm putting 100,000 in the same portfolios, but now I'm going to take 6,000 out every year. And all of a sudden that stock portfolio failed me. This is so hard for people to understand, but this is the number one thing your stock portfolio should be accounting for. There is turbulence in the stock market, period. If you want to enjoy your retirement and actually use some of your savings, you have to have investments that you can pull from when the market's not doing well. Period. Bonds are not an option anymore. That should not be in your portfolio. If you need to withdraw money from your portfolio, you're looking at where to pull from, and everywhere there are losses. And as interest rates continue to rise, you're going to continue to lose more in your bond portfolio. So please, please, please understand that you have to have a place in your portfolio to pull from that has not lost money, because the better 7% growth failed us. Okay, and every time you make that decision to pull from a portfolio that has any amounts of losses, tiny, tiny little bits of losses, if you're pulling monthly and you keep picking the stock position that you didn't like, and you sell that and pull it out, that's hurting you every single time. It's tiny little inefficiencies like that that make your money disappear. No one has intuitive brains that tell you 3% is better than 7%. That doesn't make sense. But mathematically, it can make sense once you understand the math behind that withdrawing from down positions, from positions that are losing. That math digs you into a deeper and deeper and deeper hole. Okay, so this is a lesson for people that need their money in retirement. If you're Warren Buffett, you don't need this lesson. You can invest however you want. You're still in wealth building years. Okay, and when I say if you're Warren Buffett, I'm saying, look, if you have plenty of income to pay your bills and you don't need your savings in retirement, I meet people like that all the time. Social Security and pension pays their livelihood. They fully enjoy their retirement without actually needing their money. Well, then you don't really need safe places, but you do need a place for emergencies, okay, to pull from that is not exposed from these losses. All right, thank you. That was a quick, easy topic today. We're going to keep adding topics every single week. I'm going to continue to add content, so hope you enjoyed this. If you did, hit the little like button below. Share it with friends, and please, please, please subscribe to our channel if you haven't yet. That's how this whole YouTube thing works. Subscribe to the channel, let people know about it, and we will all continue. Hope to see you soon. If you need our help with anything, feel free to give us a call or shoot us an email. We're always happy to help out. Thanks again, everybody.